I need to tell you something that still bothers me after all these years. One stupid decision I made 50 years ago cost me half my wealth. I'm not being dramatic here. I've done the math 1,000 times, and it's just arithmetic. That's the thing about compounding. It works both ways. It multiplies your smart decisions and it multiplies your dumb ones too. And here's what nobody wants to hear. By the time you hit 50, most of the big decisions in your life are already locked in. Your career path is set. Your family situation is what it is. Your ability to take crazy risks, that's gone unless you enjoy the idea of gambling away your retirement fund, which is about as smart as betting your house on red at the casino. The truth is brutally simple. After 50, you don't need to be brilliant. You just need to avoid disaster. I hear people constantly talking about finding the next big thing, the next Tesla, the next Bitcoin that's going to make them rich overnight. It's all noise. When you're over 50, the real game isn't about hitting home runs anymore. It's about survival. I grew up during the Great Depression. I watched good people, smart people, hardworking people lose everything they had. And it wasn't because they were stupid. It was because they borrowed too much money, or they trusted the wrong people, or they convinced themselves the good times would last forever. Every generation thinks they're different, but the pattern repeats like clockwork. The faces change, the technology changes, but the stupidity stays exactly the same. So here's my number one piece of advice for anyone over 50. Play defense, not offense. Your offensive years are behind you now. Those were your 20s, your 30s, maybe your 40s if you were lucky. That's when taking risks made sense, because if things went wrong, you had time to recover. But at 50, time isn't your friend anymore. Most people don't understand this basic fact. They hit middle age and suddenly panic. They think they need to catch up. So they pile everything into some hot stock or jump into a get-rich-quick scheme that promises to make up for lost time. You know what happens? They go broke faster than you can say retirement plan. Let me tell you about someone I knew. Brilliant man, Ivy League education, successful career, made good money his whole life. At 55, he looked around and decided he was behind his peers. So he took a fortune and dumped it into dot-com startups in the late 90s. Everyone was doing it. Everyone was getting rich. By 2002, he had less than half of what he started with. He spent the rest of his life talking about what he almost had. Complete waste of a good brain and good money. The sad part is, if he had just parked that money in boring, reliable companies like Coca-Cola, Procter & Gamble, Johnson & Johnson, he would have been fine. Not exciting, not glamorous, but fine. Sometimes fine is exactly what you need. People over 50 forget that the real enemy isn't underperformance. The real enemy is catastrophe. Losing half your money at 30 and losing half your money at 60 are completely different situations. At 30, you've got another 30 years to dig yourself out. At 60, you might not even live another 30 years. I know that's not cheerful to think about, but it's reality. You have to shift your thinking from trying to be clever to simply trying not to be stupid. And believe me, avoiding stupidity is a full-time job all by itself. If you're over 50, forget about chasing unicorns. Forget about trying to be the smartest person in the room. The smartest person in the room is usually broke, divorced, or both. Your goal now is durability, staying power, having enough money left to outlive your mistakes. I've always said I just want to know where I'm going to die, so I'll never go there. Well, for investing after 50, all you need to know is what will completely wipe you out, and then stay as far away from it as possible. That means no leverage. Debt is poison, especially when you don't have decades left to repay it. It means no speculation. You're not going to outtrade some 25-year-old kid with 6 computer screens and no life outside the market. And it means no complexity. The more complicated the investment deal sounds, the higher the chance that you're the one getting played. At 50, your best strategy is to keep everything boring. Boring works. Boring compounds. Boring lets you sleep at night. without worrying. The financial world doesn't reward excitement, it punishes it. So here's the paradox that most people miss. The less thrilling your investments are after 50, the more likely you are to actually enjoy a thrilling retirement. Don't aim to get rich quick. Aim not to die poor. Now let me talk about something that's destroyed more investment portfolios than any recession ever could. Envy. People don't go broke because they can't earn money. They go broke because they can't stand watching someone else earn more. I've called envy the dumbest of the 7 deadly sins, and I meant every word. You want to know why? Because it's the only sin where you don't even get to have any fun. If you're greedy, at least you get to enjoy spending the money. If you're gluttonous, you get to eat good food. If you're lustful, well, you get some pleasure out of it. But envy, you just sit there stewing in your own resentment while the other guy sails off on his yacht. You get nothing but misery. Envy is also contagious. Your neighbor buys a fancy car, and suddenly you think you need one too. Your brother-in-law won't shut up about some stock that went up 10 times, and suddenly your stable, steady investments look like a mistake. That's exactly when the trouble starts. Back in the 1990s, Warren and I owned boring businesses: insurance companies, candy stores, furniture retailers, newspapers. Nothing flashy, nothing exciting. Meanwhile, kids half our age in Silicon Valley were making billions seemingly out of thin air. We looked stupid. We looked old and out of touch until the bubble burst in 2000. Then all those same people who were laughing at our slow, steady approach were suddenly broke. And we were still rich. Here's the lesson everyone needs to learn. The game isn't about beating other people. It's about not losing yourself. Envy makes you forget that basic truth. I once knew a man who was investing reasonably well. Steady returns, decent savings, nothing spectacular but solid. Then his golf buddies got rich trading oil stocks. He couldn't stand being the small timer in the group anymore. So he loaded up on leverage and chased the exact same trades they were making. When oil collapsed, his entire portfolio collapsed with it. His buddies lost money too, but they still had their careers to fall back on. He was already thinking about retirement. At 50 or older, envy is absolutely lethal. You don't have the time to rebuild from your own stupidity. One envious decision can erase decades of patient work. The best investors I've ever known had almost zero interest in what other people were doing. They didn't care if their neighbor was bragging about a hot stock tip. They didn't care if the talking heads on television were shouting about the next big thing. They cared about staying solvent and letting their money compound quietly in the background. The real irony is this: if you actually want to be happy in your old age, you should be rooting for your friends to succeed. Envy makes you miserable every time someone else does well. What a terrible way to live. Can you imagine being 80 years old and still bitter that someone else had a bigger house 40 years ago? What an absolute waste of a life. I've outlived plenty of people who were richer than me at various points, but I never envied them. I knew most of them were playing games they couldn't possibly win over the long term. Sure enough, they burned out, or their money evaporated, or they drank themselves to death trying to keep up appearances. Meanwhile, I stayed boring, rational, and alive. So if you're over 50, here's advice you can actually take to the bank. Stop caring what anyone else earns. Stop measuring your life against your neighbor's investment portfolio. Stop scrolling through financial news and gossip as if any of it actually matters to your situation. Envy won't make you richer. It won't make you smarter. It won't even motivate you properly. It'll just push you into stupid decisions that hurt nobody but yourself. Remember this: your retirement fund doesn't care if someone else made more money than you. Your family doesn't care. The grocery store doesn't give you a discount based on your ego. Only your ego cares. And your ego has bankrupted more investors than any bear market in history. Envy isn't just a sin. It's a terrible investment strategy. Don't play it. I don't enjoy talking about my mistakes, but they're probably more useful to you than hearing about my successes. Everyone loves the winner stories. Almost nobody stops to examine the losers. But that's exactly where the real lessons are buried. Here's one of mine that still bothers me. Decades ago, I bought into a company without truly understanding its long-term future. On paper, it looked cheap. The numbers were clean. Management seemed competent enough. But I didn't think deeply enough about the actual business model and what it would look like years down the road. The result was I made a quick profit and felt pretty smart about myself. But I sold way too soon. If I'd had the patience and the insight to just hold on, that single position could have doubled my entire net worth. I'm not exaggerating. That's just the math of compounding. It doesn't forgive early exits. The mistake wasn't buying the investment. The mistake was me. I lacked the discipline to stick with a truly great business once I found it. I settled for being right in the short term instead of being rich in the long term. Most investors make this exact same error. They sell their winners way too soon because they want to lock in gains, and they cling to their losers way too long, hoping they'll recover. It's completely backward. You should do the exact opposite. But it's so hard because human nature pulls you in the wrong direction every single time. People love certainty. When something goes up, the urge to lock in the profit feels safe. It feels smart. But selling Coca-Cola stock after a modest rise back in the 1970s wasn't safe. It was foolish. That stock kept compounding for decades. Anyone who sold early spent years congratulating themselves while quietly robbing their future self blind. I don't beat myself up about it anymore. Regret is wasted energy. But I do use that memory to remind myself of one simple rule. If you find a truly great business, sit on your rear end and hold it. Don't get clever. Don't get itchy fingers. Don't convince yourself you need to do something. The world constantly tempts you to act. Turn on the news and you'll see endless reasons to make a move. Elections, wars, inflation, recession fears. But most of that is just noise. Good businesses survive all of it. Great businesses actually thrive through it. Your job is not to outguess every single headline. Your job is to avoid selling the goose that's laying golden eggs. For people over 50, this lesson matters even more. You don't have the luxury of making a big mistake and then waiting 40 years for compounding to bail you out. One wrong exit, one badly timed clever move, and your nest egg can shrink permanently. I see this all the time. Someone holds a reliable dividend-paying stock for decades. Then they read some newsletter about a disruptor that's going to change everything, and they decide to rotate their money out. They dump Johnson & Johnson to chase some tech company's initial public offering. A few years later, they're sitting there wondering why their income dried up and their account is bleeding red. The mistake isn't failing to predict the future. Nobody can do that. The mistake is abandoning what actually works just because something else excites you more. Excitement is a terrible investment strategy. I could have been significantly richer if I'd learned this lesson earlier in life. But at least I did learn it eventually. Many people never do. They spend their entire lives hopping from one opportunity to the next, while the boring investor living next door quietly builds real, lasting wealth. So here's what you need to take away from this. It's not brilliance that makes you rich over time. It's endurance. It's the ability to hold on tight when everything around you is tempting you to let go. If you're over 50, you simply cannot afford to repeat my mistake. When you find a business that's going to still be making money 20 years from now, hold it. Sit still. Don't sabotage yourself by trying to be clever. In the end, the market rewards the patient, not the excitable. I became wealthy by being consistently not stupid, not by chasing after brilliance. The older I get, the more I realize this fundamental truth. Most people are far too confident in their own opinions, and the market punishes that kind of arrogance sooner or later. I've been watching it happen for nearly a century now. In the 1930s, people were absolutely certain that prosperity would never return. They hoarded cash under mattresses and missed the entire rebound. In the 1960s, everyone was sure that America's big companies would keep compounding at high rates forever. They completely ignored valuations and got crushed in the 1970s. In the 2000s, investors thought technology stocks could only go up. We all know how that story ended. Confidence feels good. It makes you feel smart and in control. But confidence is not correlated with accuracy. In fact, I've seen the exact opposite pattern play out over and over. The people who sounded the most certain about the future were usually the ones who lost the most money when reality showed up. Here's what you need to understand. The world is far too complex for anyone to know everything about it. You don't get rich by being a know-it-all. You get rich by knowing what you don't know and staying far away from it. When Warren and I built Berkshire, we passed on literally thousands of opportunities. We didn't understand them well enough, so we just ignored them completely. And you know what? We didn't actually miss much. The world throws plenty of pitches at you every single day. You don't have to swing at every one of them. But most investors can't resist. They think having an opinion about everything makes them look smart and informed. They'll tell you exactly where oil prices are headed, what interest rates will do next year, and how some brand new startup is going to revolutionize an entire industry. What they conveniently don't mention is that 90% of those confident opinions will turn out to be completely wrong. At over 50, this personality flaw becomes genuinely dangerous. You don't have the same margin for error as some young gambler in his 20s. If you throw serious money behind your half-baked opinion about something you don't really understand, the market will not forgive you. And unlike when you were 30, you don't get another 30 years to rebuild what you lost. I once watched a successful lawyer out in Los Angeles. Sharp guy, good income, respected in his field. He decided he was also an expert on currency markets. He read a few articles, formed a strong opinion, and bet heavily against the Japanese yen. It wiped out most of his retirement savings. Not because the yen was predictable, that much was obvious to everyone, but because he was way too confident in his ability to predict which direction it would move and when. The real irony? If he'd just admitted, I don't know anything about currency trading, and left his money in something boring and simple, he would have been completely fine. But people would rather be wrong loudly than stay silent and wise. Here's what I strongly recommend. Develop the courage to say, I don't know. It's a rare trait, and it's incredibly valuable. If you can admit ignorance about something, you won't bet money on nonsense. You'll stick to the few areas where you actually have real competence. That's exactly what we did at Berkshire. We understood the insurance business. We understood Coca-Cola. We understood candy stores. So we bought them. We didn't understand airlines. We didn't understand .com stocks. So we left them completely alone. That one simple habit saved us from disaster more times than I can possibly count. Overconfidence kills more investors than recessions do. It's not the market that ruins you. It's your illusion that you know more than you actually do. So if you're over 50, listen to me carefully. Stop acting like you're some kind of oracle. You don't need opinions about every sector, every trend, every country's economy. You only need to know a handful of things really well, and then have the honesty to admit you know absolutely nothing about everything else. In fact, I'd go even further than that. The more certain someone sounds when they're talking about the future, the faster you should run in the opposite direction. The world is absolutely full of people who are eager to sell you certainty. Analysts, pundits, salesmen, they all sound incredibly smart and convincing. But not a single one of them is going to pay your bills when their certainty blows up your retirement portfolio. So the next time you feel that itch to predict something unpredictable, just stop yourself and ask one simple question. What if I just don't know? That question alone might save your entire retirement. One of the biggest divides I've observed in life isn't between rich and poor. It's between people who think like employees and people who think like owners. And this has absolutely nothing to do with job titles or the size of someone's paycheck. It's purely about mindset. Most people, even very intelligent ones, spend their entire lives playing career games. They're constantly optimizing for promotions, fancy titles, corner offices, and small perks. They waste years trying to impress bosses they don't even respect. They polish their resumes instead of building actual wealth. That's careerism, and it's an absolute trap. I've said many times that the world isn't driven by greed, it's driven by envy. Careerism feeds directly on that emotion. You watch the person next to you get a fancier title, and suddenly you want one too, even if it means nothing. But here's the thing, titles don't compound, ownership does. When Warren and I built Berkshire, we didn't care one bit about looking important to other people. We cared about owning things that made money while we were sleeping. Candy companies, Coca-Cola, insurance businesses. They didn't care whether we had vice president on our business cards or senior partner on our door. They just kept sending us checks month after month. Meanwhile, I watched brilliant lawyers, successful bankers, and top executives waste entire decades climbing corporate ladders that led nowhere meaningful. They earned high incomes, sure, but they owned nothing that actually worked for them. The minute they stopped showing up to the office, the money stopped flowing too. That's not real wealth. That's just a high-class treadmill. You're running faster and making more noise, but you're not actually getting anywhere. Let me give you a concrete example. Back when I was practicing law, I worked alongside some of the sharpest legal minds you could possibly imagine. They billed clients by the hour, made what looked like a fortune, and genuinely thought they were kings of the world. But if any of them dropped dead tomorrow, their income would have dropped dead right alongside them. They owned nothing scalable, nothing durable, nothing that could outlast them. They were just highly paid employees pretending to be wealthy. By contrast, Warren and I deliberately channeled our time and energy into building ownership stakes. We wanted businesses that didn't depend on our physical presence every single day. That way, even if we were out playing golf, or let's be honest, even if we were dead, those assets would keep compounding and working. That's the fundamental difference. If you're over 50, this lesson matters more than almost anything else. You don't have endless time left to keep trading your hours for dollars. Eventually, your energy is going to run out. Your health is going to fail. The treadmill is going to stop whether you're ready or not. So ask yourself this honest question. Do you own anything that actually works for you when you're not working? Real estate that generates rental income every month. Stocks that pay reliable dividends. A business stake that keeps earning whether you show up or not. If your honest answer is no, then you're not really investing at all. You're just extending your employee career under a different name and calling it something else. Careerism also clouds your judgment in dangerous ways. Employees spend their time thinking about how to please their bosses. Owners spend their time thinking about how to survive economic reality. That's a massive difference in perspective. A career-focused lawyer will do whatever makes the senior partner happy, even if it's stupid. An owner asks one simple question. Does this actually make money over the long term? Only one of those questions leads to compounding wealth. I'll tell you something harsh that most people don't want to hear. If you're over 50 and still living paycheck to paycheck, no matter how large that paycheck happens to be, you've probably been thinking like a careerist for way too long. You've been optimizing for the wrong game this whole time. The good news is you can still make the shift. It's not too late. Stop obsessing over titles and what your colleagues think of you. Start caring about ownership. That doesn't mean you have to quit your job tomorrow morning. It just means redirecting your energy and your capital into assets that are going to outlast you. Buy boring, durable businesses that will still be around in 20 years. Live well below your means instead of trying to keep up appearances. Build ownership stakes instead of wasting money on things that make you look successful to people you don't even like. It's a much quieter game. Nobody applauds when you buy shares of Procter & Gamble. There's no party, no congratulations. But in 20 years, those shares are going to be paying you steady income when all that applause has long since faded away into nothing. Careerism fades fast. Ownership compounds slowly. Pick the one that's actually going to matter when you're 70 years old. If you lived through the Great Depression like I did, you never really forget it. Not completely. I was born in 1924. By the time I was old enough to understand what was happening, the entire economy had collapsed. Banks were failing left and right. Businesses were folding. Families were going hungry in the streets. People today think volatility means the stock market drops 10% and everyone panics. In 1932, the market had fallen almost 90% from its peak. That wasn't volatility. That was complete financial annihilation. I personally watched grown men lose their entire livelihoods overnight. I saw families forced to move in together because they couldn't afford to pay rent on their own places. My own family understood what it meant to cut every possible corner and stretch every winner, the single dollar as far as it would go. It was grim, it was frightening, and it left a permanent mark on how I see risk for the rest of my life. The biggest lesson I learned: you absolutely cannot count on good times lasting forever. People today seem to forget that basic truth. They think prosperity is just the default setting of the universe. It isn't, not even close. Civilizations rise and fall. Economies swing violently between feast and famine. If you live long enough, you're going to see both extremes with your own eyes. The Depression taught me to respect reality above everything else. Optimism is fine in small doses, but blind optimism kills. Plenty of people in the 1920s genuinely thought the good times would never end. They borrowed money against everything they owned. They speculated wildly. They leveraged themselves into complete oblivion. When the crash finally came, that debt destroyed them utterly. That's exactly why I've always absolutely despised debt. Debt makes you fragile. With no debt, you can survive bad times and wait them out. With debt, bad times kill you. Another critical lesson: resilience beat brilliance every single time. I watched small, boring businesses survive the Depression by being incredibly frugal and adaptable. Meanwhile, fancy operators with clever schemes and big talk vanished overnight like they never existed. The survivors weren't geniuses. They weren't the smartest people in the room. They were simply durable enough to outlast the crisis. That's a lesson most investors still don't understand even today. Everyone wants to be clever and impressive. Nobody wants to focus on just being durable. Yet durability is exactly what gets you through a once-in-a-lifetime economic collapse. I carried all those lessons directly into my investing career. I don't waste time trying to predict when the next recession is coming. Nobody can do that reliably. What I do instead is assume that bad times will eventually come because they always do, and I prepare accordingly. That means always keeping a margin of safety in everything. That means avoiding leverage like poison. That means owning businesses that sell products people will keep buying in good times and bad times. Things like candy, soda, insurance, basic necessities. People actually mocked us for buying See's candies. They'd say, "How much money can you possibly make selling chocolates?" They laughed at us. Well, it turns out people still eat chocolate during recessions. In fact, they eat more of it because it's a small, affordable pleasure when everything else feels terrible. See's survived downturns that absolutely crushed much flashier businesses. That's the kind of lesson you only learn after seeing true hardship with your own eyes. Now, if you're over 50, you need to remember this above everything else. You don't get a chance to live through another Great Depression and learn these lessons the hard way. If you blow up your finances once at this age, you will not live long enough to rebuild. That's just reality. That's why you absolutely must structure your entire portfolio for resilience, not for fantasy returns. When you hear people bragging about how much leverage they're using, or how brilliant their trading strategy is, or how much money they're making, I want you to remember 1932. Remember the breadlines. Remember grown men who thought they were financial geniuses suddenly standing in soup kitchens begging for food. The world has changed enormously since then. We have different technology, different industries, different problems. But human nature, that hasn't changed one bit. People still get greedy. They still take on way too much debt. They still assume good times will roll on forever. And every few decades, reality comes along and slaps them hard across the face. So my advice is brutally simple. Learn from history you didn't personally live through. You don't need to experience another Great Depression to understand the danger of financial stupidity. All you need is a little humility and a functioning memory. If I had to reduce everything people call my success down to just 3 habits, it would be this. I avoided debt, I avoided drama, and I avoided dumb people. That's it. No magic formulas. No secret insider knowledge. Just relentless subtraction of the things that destroy most people. Let's start with debt, because this is critical. I've said it before and I'll say it again until I'm dead. Debt is absolute poison. It destroys discipline. It magnifies every stupid decision. And it guarantees that when bad times inevitably come, and they always come eventually, you're going to be the very first person to get completely wiped out. I watched people in the 1930s borrow money against their homes because they thought they were being smart and safe. When the crash came, they lost absolutely everything. That image burned itself into my brain and never left. Warren and I built Berkshire completely without leaning on borrowed money. We could have juiced our returns with leverage. Plenty of people told us we should, but 1 or 2 wrong bets with debt attached, and we would have been broke just like everyone else who got greedy. Staying solvent was infinitely more important than looking clever to other people. If you're over 50, debt is absolutely lethal to your future. At 30, maybe you have time to recover from a mistake. At 60, it's game over. You will not live long enough for compounding to save you from a major debt disaster. Now, drama. I have never tolerated it, not for 1 second. I deliberately avoided unnecessary fights, pointless feuds, and people who seem genuinely addicted to chaos and conflict. Drama wastes enormous amounts of energy that could be spent thinking clearly, building patiently, or simply enjoying your life. Plenty of genuinely smart men have been completely ruined, not by bad investments, but by bad divorces, bad business partnerships, or just bad tempers they couldn't control. You can be absolutely brilliant when it comes to finance and still bankrupt yourself with personal chaos. I was never interested in playing that game. Then there's dumb people. And when I say dumb, I don't just mean low intelligence. I mean people who are reckless, dishonest, unreliable, or addicted to shortcuts and quick fixes. They're radioactive. Their stupidity spreads like a disease. Hang around them long enough and you will get caught in the fallout when everything explodes. Early in my career, I watched colleagues get involved with slick operators who promised big returns and easy money. The pattern was always exactly the same. Fast talk, shady deals that didn't quite make sense, and then inevitable collapse. Those smart colleagues ended up getting dragged down simply by association, even though they should have known better. I made it an absolute rule early on, better to have fewer friends and business partners, but make sure every single one of them is high quality. My partnership with Warren worked successfully for over 50 years. Not because we never disagreed about anything. We disagreed plenty. But because we shared the exact same core principles: rationality, patience, honesty, no drama, no debt, no tolerance for stupidity. That shared foundation made us incredibly durable. Most people dramatically underestimate how much avoiding the wrong things actually matters. Everyone spends all their time looking for the right stock, the right deal, the right opportunity. They completely ignore the fact that saying no is vastly more important than saying yes. One good yes might make you some money. One wrong yes can ruin you forever. If you're over 50, this is not optional anymore. It's not a suggestion. You cannot afford to waste years untangling yourself from terrible decisions. Your margin for error is gone. So cut ruthlessly. No debt, no drama. No dumb people in your life. It sounds harsh when I say it out loud, but it buys you something priceless: peace of mind. And peace of mind is worth far more than squeezing out a few extra percentage points of return on your investments. Remember this: wealth is not built by brilliance, it's preserved by discipline. And most discipline is just the ability to walk away from stupid temptations that look good in the moment. People absolutely love to romanticize my partnership with Warren. They imagine we sat in some ivory tower playing chess with billions of dollars, always in perfect agreement, always making brilliant moves together. That's complete nonsense. What actually worked between us wasn't magic or genius. It was discipline, compatible temperaments, and mutual trust. And what didn't work? Well, let's just say we made our fair share of blunders over the years, though definitely fewer than most people. Here's what worked first and foremost. We trusted each other, completely and totally. No backstabbing, no internal politics, no jealousy or competition. That's incredibly rare in business. I didn't wake up in the morning worrying that Warren was somehow scheming against me behind my back, and he knew exactly the same thing about me. That complete trust gave us enormous efficiency. Most organizations waste literally half their energy on stupid internal nonsense and politics. We didn't have to deal with any of that. We also thought exactly the same way about money and investing. We both valued patience above everything. We valued rationality and independence. Neither one of us cared even slightly about looking fashionable or chasing Wall Street's approval. If something didn't make logical sense to us, we simply didn't touch it, no matter how many supposedly smart people mocked us for being old-fashioned. Another thing that worked incredibly well was our complementary skills. Warren was an absolute genius at spotting undervalued businesses that nobody else was paying attention to. I was better at reminding him not to get seduced by what we called cigar butts. Those were crummy little companies you could buy dirt cheap and maybe sell for a tiny profit. Together, we learned to aim much higher. We focused on buying quality businesses at fair prices and then just holding them forever. That single shift in thinking was worth billions of dollars over time. Now, what didn't work perfectly? Well, for one thing, we weren't perfect judges of human character. We occasionally backed managers who turned out to be either crooks, complete fools, or both. You can't screen for every possible human weakness, but it annoyed us greatly when we got it wrong. Character matters enormously in business, and when we misjudged someone's character, it cost us real money. We also badly underestimated how incredibly hard it is to change human behavior in corporate culture. Some companies look completely fixable on paper. You think better. Management, better incentives. Maybe you can turn things around. But you can't change corporate culture easily. If the fundamental DNA of a company is rotten, putting up new wallpaper isn't going to help. We learned that lesson the hard way more than once. And yes, we definitely missed opportunities along the way. People seem to think Berkshire grabbed every single good investment opportunity that came along. Wrong. We passed on thousands of things. Some of them would have been spectacular in hindsight. Technology companies, for instance. Warren has admitted publicly he didn't understand them well enough to invest confidently. Neither did I, to be honest. In that sense, our natural caution definitely cost us some upside. But I'll tell you what, I would much rather miss out on potential upside than blow myself up chasing something I don't actually understand. That caution may have cost us billions in missed opportunities, but it also saved us from disasters that would have cost us far more. Our single biggest strength was knowing the limits of our own knowledge. Most investors simply don't have that self-awareness. They want to be experts on absolutely everything. They can't admit ignorance. We could. We were perfectly comfortable saying we don't know. We stuck religiously to our circle of competence. If something was outside that circle, we just said no and moved on. That one simple habit explains most of Berkshire's long-term durability better than anything else. If you're over 50, you should think very carefully about partnerships the same way we did. Ask yourself honestly, does this person make me more rational or less rational? Do they bring stability to my life or do they bring drama? Do they amplify my natural strengths or do they magnify my weaknesses? The wrong partner can completely ruin decades of hard work in a shockingly short time. The right partner can multiply your effectiveness beyond what you could ever do alone. In the end, what worked between Warren and me wasn't some kind of supernatural brilliance. It was simple compatibility. And what didn't work were the rare moments when we forgot our own rules and got careless. So don't mythologize us or put us on some pedestal. We weren't gods. We were just two stubborn men who happened to share almost the exact same brain when it came to thinking about money, and that was enough. Here's something most people absolutely do not want to hear, but it's true. Getting rich after 50 is much less about making brilliant moves and much more about simply avoiding fatal ones. At that age, survival itself becomes the strategy. You can definitely still build real wealth after 50. I've seen plenty of people do exactly that, but they didn't do it by chasing hot tips or trying to trade stocks like they're 20 years old. They did it by being boring, steady, and relentlessly rational year after year. The surprising truth that nobody wants to accept is this: you don't need to double your money overnight. You just need to not blow yourself up. Let me give you a concrete example. I knew a doctor once. Good income, sensible about spending, nothing flashy. At 55, he started methodically funneling his savings into a basket of high-quality dividend-paying stocks. He completely ignored all the noise and excitement. He just kept reinvesting those dividends and living well below his means. By 70, he wasn't spectacularly rich. He wasn't buying yachts or private jets. But he was completely financially free. No debt whatsoever, plenty of reliable income, comfortable, secure, independent. Now, compare that to another man I knew. Sharp entrepreneur, very confident, thought he knew everything. At 52, he looked around and decided he was way behind where he should be. So he took his entire savings and dumped it into speculative real estate deals, leveraged absolutely to the hilt. When the market turned against him, which markets always eventually do, he was completely bankrupt by 57. The difference between these two men wasn't intelligence or education. It was purely discipline. Here's the paradox nobody seems to understand. At 50, you genuinely don't need brilliance to win the money game. You just need to stop doing stupid things. And believe me, the world offers you an absolutely endless buffet of stupid things to choose from. Cryptocurrency scams, day trading fads, exotic real estate schemes, friends can't miss business ideas. The list literally never ends. If you want to get rich, or at least stay rich after 50, here are the rules you must follow. Keep everything simple. Own businesses or assets you actually understand completely. If you can't explain it to your spouse in less than 1 minute, you probably shouldn't own it at all. Preserve your capital like your life depends on it, because it does. Every single dollar you lose at 60 is far more expensive than every dollar you lost at 30. You don't have decades left to recover anymore. Avoid envy like it's a plague. Don't waste energy looking at the guy who supposedly doubled his money in some risky bet. Most of the time, he won't actually keep it anyway. Your job is not to keep up with anyone. Your job is to stay standing when everyone else falls down. Play defense, not offense. A steady 7% return, compounded over 15 years, is an absolute miracle when you're 50. It doubles your money. Then it doubles again. By the time you're actually retired, you'll look genuinely rich to anyone who spent those same years chasing fads and excitement. Most people over 50 completely forget this simple truth. You don't have to be spectacular. You don't have to beat the market. You just have to be solvent and patient. The world has a beautiful way of rewarding the people who simply endure long enough. The truth is, I never actually planned to become a billionaire. That was never the goal. I just avoided stupidity consistently for long enough that compounding did all the heavy lifting for me. I massively overshot any reasonable target. That's the game. So if you're over 50 and genuinely worried that it's too late for you, stop panicking right now. You don't need to reinvent yourself. You don't need to find the next big thing. You don't need to be a genius. You just need patience, simplicity, and durability. It's not glamorous advice. It won't get you on television or make you feel like a genius. But it's the only advice that actually works in the real world. If you want one final blunt truth to end on, here it is. If you are not spending less money than you earn, absolutely nobody can help you. Not me, not Warren, not the smartest financial advisor on the entire planet. The laws of arithmetic don't care about your feelings. They don't care about your lifestyle or what you think you deserve. They don't care about your excuses. If more money flows out of your life than flows in, the end result is mathematically guaranteed. You will go broke. It's just a matter of time. I've watched people earning six-figure incomes every year end up living like paupers in their old age. Why? Because they could not resist spending every single dollar they made, and usually more. And I've watched people with modest, ordinary incomes die comfortable and independent because they lived simply and invested consistently for decades. It's not about intelligence. It's not about lucky opportunities. It's purely about behavior and self-control. Overspending is the absolute fastest way to completely ruin any investment plan, no matter how clever it is. It doesn't matter if you're 25 or 65. If you keep digging the financial hole deeper every month, compounding starts working against you instead of for you. People constantly ask me, Charlie, what's the very best investment for someone my age? My answer is almost always the same. Stop buying nonsense you don't actually need. That advice alone would solve at least half the financial misery in the world. At over 50, the consequences become even sharper and more painful. You don't get to make infinite mistakes anymore. You don't get to start completely over every decade like you're still young. Your choices right now either set you up for a dignified, independent retirement, or they set you up to depend on your children or the government. The goal at this stage of life isn't glamour or excitement. It isn't chasing the biggest possible return. The goal is simple dignity. Independence, knowing with absolute certainty that you will not have to beg your kids for money when you're old, knowing you won't have to work until you literally drop dead. And that kind of security doesn't come from clever trades or hot stock tips. It comes purely from restraint and discipline. If you cut out debt completely, avoid drama and toxic people, ignore the dumb people trying to drag you into their schemes, and consistently live well below your means, you've already beaten 90% of humanity at the money game. Do that consistently for long enough, and compounding will handle everything else for you automatically. But if you overspend and live beyond your means, forget everything I've said. Nobody can save you, not even the stock market gods themselves. So here's my final question for you to think about seriously. When you're 70 years old, do you want to spend your time envying your neighbor's expensive toys, or do you want to actually enjoy your own freedom and independence? The choice is completely obvious. The execution is tragically rare. Remember this above all else. The world doesn't reward brilliance nearly as much as it rewards simply avoiding stupidity. And absolutely nothing is more stupid than spending yourself into complete misery when you're old and have no way to recover. That's the truth. Now go do something about it.